Most traders lose everything, not because the market is random, but because they never knew it was moving in a cycle. Every rally you missed, every crash that wiped your account, they weren't accidents. The market has always followed the same 4 stages: accumulation, uptrend, distribution, downtrend, repeating like clockwork, driven by the same professional hands absorbing and offloading stock. Once you see the cycle clearly, you stop fighting it, you trade with it. The market was never chaos, it was always a plan. Most traders lose everything, not because the market is random, but because they never knew it was moving in a cycle. You've watched it happen. A stock climbs steadily for weeks. You finally buy, convinced this time is different. Then, without warning, it collapses, your account bleeds. The news calls it a crash. The analysts call it unexpected. But I assure you, nothing about that move was unexpected. You simply did not know where you were standing inside the cycle. That is the cruelest truth of the market. It punishes not the unintelligent, but the uninformed. Every loss you've absorbed. Every position stopped out at the worst possible moment. Every rally you chased only to watch it reverse the very next session. These were not random misfortunes. They were the inevitable consequence of trading without understanding the most fundamental law governing all financial markets: the price cycle. Now, before you act on any chart you see today, pause, because acting without this knowledge is precisely what keeps retail traders permanently on the wrong side of professional money. Here is what the tape has always revealed. If only one knew how to read it, markets do not move in straight lines. They move in a 4-stage cycle: accumulation, uptrend, distribution, and downtrend, repeating continuously across every instrument, every time frame, and every era of market history. In the accumulation phase, large professional operators quietly absorb available supply. Price appears dull, directionless. The news is grim. Retail traders are exiting. This apparent weakness is manufactured. While the uninformed sell, the well-informed are buying every share offered. In the uptrend phase, demand overwhelms supply, price advances. The public grows excited and begins to participate, but only after the professionals have already positioned themselves at far lower prices. Volume confirms the move. Each pullback is shallow. The path of least resistance is clearly upward. In the distribution phase, those same professionals, now sitting on enormous unrealized gains, begin offloading their positions to the eager public. Price moves sideways, creating the illusion of consolidation. The news turns optimistic. Retail buyers step in aggressively. But behind the scenes, stock is changing hands from strong hands to weak. In the downtrend phase, supply overwhelms demand. Price falls, panic spreads. The retail trader, now holding stock accumulated at peak prices, sells at a loss, and the professionals, now short or in cash, prepare again to accumulate at lower levels. This cycle has repeated without interruption. Through the crash of 1929, through the dot-com collapse, through the 2008 financial crisis, through every Bitcoin peak, and through every modern algorithmic sell-off you've witnessed on your screen. The mechanics change. The technology changes. The cycle never does, because human nature does not change. Greed and fear are as present in today's algorithmic markets as they were on the floors of the New York Stock Exchange a century ago. Once you internalize this cycle, you stop being the counterparty to professional money. You begin moving with it. That is where consistent trading begins. Every rally you missed, every crash that wiped your account, they weren't accidents. Think carefully about the last time the market moved violently against you. You had logic on your side. Your analysis was reasonable. Your entry appeared sound. Then the price moved, not gradually, not hesitantly, but with surgical precision, directly into your stop loss. And the moment you were forced out, the market reversed and moved exactly where you originally anticipated. That did not happen by coincidence. That moment, that precise, painful moment, was engineered, And until you understand by whom and why, it will keep happening to you. Most retail traders carry a dangerous assumption. They believe the market is a level playing field, that price moves because of news, earnings reports, economic data, or collective sentiment. They believe crashes are triggered by external events. They believe rallies emerge organically from improving fundamentals. This belief is exactly what the professional operator depends upon. Stop. Before you place another order today, consider this carefully. In every major market you trade, equities, forex, futures, cryptocurrency, there exist participants operating with resources, intelligence networks, and order flow data that dwarf anything available to the individual trader. These are the institutions, the funds, the professional operators of the modern era. Their methods have evolved. Their intent has not. They require one essential ingredient to move markets in their favor: liquidity. And liquidity, in its most abundant form, exists precisely where retail traders place their stop losses, their breakout entries, and their emotional decisions. When price breaks a clean support level that every retail trader has been watching, that is not random selling pressure. That is a deliberate reach for the stop losses resting below that level. The professional absorbs those forced sell orders as purchases. Price then reverses sharply upward, leaving the retail trader stopped out at the exact low of the move. This is the spring. This is the upthrust. These are not chart patterns. They are the deliberate fingerprints of professional capital operating within the cycle. In today's markets, algorithms execute these maneuvers in milliseconds. High-frequency systems are specifically programmed to identify liquidity clusters, the areas where retail stop orders accumulate, and to reach those levels with calculated precision before reversing. The technology is modern. The underlying behavior is identical to what the tape revealed a century ago. Because the motivation never changes, the professional must find counterparty volume to build and exit large positions. The retail trader, acting on emotion and incomplete information, provides exactly that counterparty at exactly the wrong moment. Understanding this does not make you powerless. It makes you dangerous. When you recognize that every significant move in the cycle is preceded by a deliberate liquidity grab, you stop placing stops where everyone else places them. You stop chasing breakouts the moment they occur. You begin reading the market as a professional reads it, not reacting to price, but anticipating the intent behind it. The market was never working against you randomly. Now you know where to look. The market has always followed the same 4 stages: accumulation, uptrend, distribution, downtrend, repeating like clockwork, driven by the same professional hands. You have stared at charts for hours, studied indicators, read analyst reports, followed market commentators with hundreds of thousands of followers. And yet, the market continues to humiliate you at precisely the moments you feel most certain. Perhaps you have begun questioning your own judgment entirely. Perhaps you have convinced yourself that consistent profitability is reserved for institutions with supercomputers and inside information. Perhaps you have accepted losing as simply the cost of participation. That resignation is the most expensive mistake a trader ever makes, because the answer was never hidden inside a more sophisticated indicator. It was never buried inside a proprietary algorithm. It was visible on the chart the entire time, written clearly in the language of price and volume, waiting for someone with the patience and knowledge to read it correctly. Before that next trade, before that next impulsive entry driven by the fear of missing a move, understand what you are actually looking at when you open a chart. What separates consistently profitable operators from the perpetually struggling retail trader is not superior technology or exclusive data. It is the understanding that markets do not behave randomly. They move through a deliberate, repeating sequence, a cycle governed by the accumulation and distribution of stock between informed and uninformed participants. This cycle has 4 distinct stages, and each stage carries a completely different set of implications for how price will behave, where volume will appear, and where the professional operator is positioned. Accumulation is where the campaign begins. Price is depressed. Sentiment is negative. The retail trader is exiting. In today's markets, this stage often appears as a long, grinding sideways consolidation following a significant decline, the kind of price action that algorithmic momentum strategies abandon entirely and financial media ignores completely. This is precisely where the professional operator builds his position quietly, patiently, across hundreds of individual transactions designed to avoid detection. The uptrend is the effect of that accumulated cause. Price advances with increasing momentum. Volume confirms the move. In modern markets, this stage accelerates rapidly as algorithmic trend following systems pile in behind the initial institutional move, amplifying the advance and creating the appearance of broad market strength. Distribution is the most deceptive stage. Price moves sideways near highs. Sentiment is optimistic. Financial media celebrates the rally. Retail participation reaches its peak. Simultaneously, the professional operator, having accumulated at significantly lower prices, is systematically transferring that stock to the eager, uninformed public at the highest possible average price. The downtrend is the inevitable consequence. Supply overwhelms demand. Price declines. In today's leveraged, algorithm-driven markets, downtrends accelerate with a velocity that devastates underprepared retail positions within sessions. These 4 stages repeat without exception across every market, every instrument, and every time frame you will ever trade Bitcoin. The S&P 500, crude oil, currency pairs, individual equities. The cycle governs all of them equally. Read the cycle correctly, and the market stops feeling like your adversary. It begins feeling like a map. Once you see the cycle clearly, you stop fighting it. You trade with it. Consider how many trades you have placed in direct opposition to the prevailing market structure. Not because you intended to fight the market. Not because you were reckless or undisciplined. But because you were reading the wrong signals at the wrong moment, reacting to price movement rather than understanding the structural conditions that produced it. You sold into accumulation. You bought into distribution, and each time the market moved against you with a conviction that felt deeply personal. It was not personal, but it was predictable. And that distinction between feeling victimized by the market and understanding its structural logic is the precise distance between a struggling trader and a consistently profitable one. Before you dismiss this as theoretical, before you return to the same indicators, the same news feeds, the same reactive decision-making that has produced the same results, consider what trading genuinely with the cycle actually means in practice. Most traders believe they are trend followers. They are not. They are emotion followers. They follow the feeling of momentum after it has already been established, entering long when confidence is highest, which is precisely when distribution is most advanced. They exit short positions when fear peaks, which is precisely when accumulation is beginning. They are always one stage behind the professional operator, and that single stage of delay is the difference between consistent profitability and consistent frustration. Trading with the cycle requires understanding each stage not as a label, but as a set of specific, observable conditions that price and volume reveal on any modern chart. During accumulation, volume contracts during downward movements and expands on upward reactions. Price repeatedly tests lows without achieving meaningful continuation. Bearish momentum gradually exhausts itself. In today's markets, this behavior appears identically whether you are analyzing a daily equity chart, a 4-hour cryptocurrency chart, or a 15-minute futures chart. The time frame is irrelevant. The structural logic is universal. During the uptrend, impulsive moves travel further than corrective pullbacks. Volume confirms each advance. Pullbacks are shallow and brief. The modern algorithmic environment amplifies this stage dramatically. Trend, following systems accelerate moves that the professional operator initiated, creating extended trending conditions that reward those already positioned correctly. During distribution, upward movements lose momentum progressively. Volume remains elevated, but price fails to register meaningful new highs. The effort-to-result relationship deteriorates visibly. Selling pressure disguises itself as volatility. In today's markets, this stage is frequently accompanied by intensely optimistic financial media coverage, precisely the environment in which uninformed retail participation peaks. During the downtrend, supply controls every attempted recovery. Rallies are brief, labored, and unconvincing. Volume expands on declines and contracts on recoveries, the mirror image of healthy uptrend behavior. When you genuinely internalize these structural characteristics, you no longer need to predict the market. You rid it. You enter accumulation with patience rather than frustration. You hold uptrends with conviction rather than anxiety. You step aside during distribution rather than chasing deteriorating momentum. You recognize downtrends early rather than averaging losing positions into declining markets. The cycle does not change. Markets do not change. Professional behavior does not change. Only your understanding of it needs to. The market was never chaos. It was always a plan. There is a moment every serious trader eventually faces. It arrives after enough losses, after enough sleepless nights spent reviewing positions that made complete logical sense, until the market dismantled them with what appeared to be pure, indiscriminate chaos. After enough times watching price spike violently through a level, trigger every visible stop, then reverse immediately and move precisely where the original analysis suggested it would go. At that moment, most traders make one of two choices. They either abandon the market entirely, concluding that profitability is a myth reserved for insiders, or they double down on complexity, adding more indicators, more filters, more conditions, believing sophistication will eventually decode the randomness. Both conclusions are wrong, because the premise beneath them is wrong. The market is not chaotic. It never was. Step back from that next impulsive trade. Step back from the noise of today's price action, the conflicting signals, the contradictory headlines flooding your financial feed right now, and consider the following with complete seriousness. Every significant price movement you have ever witnessed, every dramatic rally, every devastating collapse, every frustrating sideways grind that tested your patience beyond its limits was the direct result of a deliberate campaign executed by professional operators with clearly defined objectives. These objectives have never changed across a century of market history. The professional operator enters a market to accomplish one thing: to accumulate a large position at the lowest possible average price, advance that position through a trending move, distribute that position at the highest possible average price, and profit from the difference. That is the plan. It has always been the plan. In today's markets, this plan executes across institutional trading desks, quantitative hedge funds, and high-frequency algorithmic systems simultaneously. The instruments are modern. The execution is faster. The data infrastructure is incomprehensibly sophisticated compared to the ticker tape of a century ago. But the plan itself, the structural logic of accumulation, advancing, distribution, and declining, operates today with identical precision to what the tape revealed in every previous era of market history. What appears as chaos is specifically the accumulation phase, where price oscillates unpredictably, sentiment is confused, and direction appears genuinely unknowable. This confusion is not accidental. It is the necessary environment for the professional operator to build a significant position without detection. Obvious directional movement during accumulation would attract competition, driving prices higher before the position is fully established. What appears as irrational exuberance at market peaks is specifically the distribution phase, where optimism is deliberately cultivated through price action that feels strong but is structurally deteriorating. The professional operator requires retail buying pressure to exit his position. Manufactured confidence produces exactly that. What appears as senseless panic during declines is specifically the professional operator's exit creating vacuum. Supply overwhelming demand in a market where informed participants have already repositioned. None of it is random. All of it is readable. Price tells the truth. Volume confirms it. The cycle reveals the plan behind both. You were never trading chaos. You were simply missing the context to read the order within it. Once you internalize this cycle, you stop being the counterparty to professional money. You begin moving with it. Every single trade you have ever placed has had a counterparty. Someone took the opposite side of your buy order. Someone absorbed your sell. And in the vast majority of transactions executed by uninformed retail participants, that counterparty was not another confused retail trader making an equally emotional decision. That counterparty was a professional operator, methodically building or exiting a position using your order as the liquidity he required to do so. Read that again slowly, because the full weight of that reality determines everything about why most traders have remained permanently unprofitable regardless of how many years they dedicate to the craft. You have not been losing to the market. You have been losing to the participant on the other side of your trade, the participant who understood precisely where you were standing inside the cycle when you placed that order. Before you open another position today, before you act on whatever signal currently appears compelling on your screen, understand what it genuinely means to stop providing that counterparty and begin demanding it instead. The transition from counterparty to professional money to moving alongside it is not achieved through a better indicator. It is not achieved through faster execution or more sophisticated charting software. It is achieved exclusively through one thing: the genuine internalization of what the cycle reveals about where professional money is positioned at any given moment. When you identify accumulation correctly, through the contraction of volume on downward movements, through the progressive exhaustion of bearish momentum, through the deliberate testing of lows that fails to produce continuation, you are no longer selling into professional buying. You are buying alongside it. Your order is no longer the liquidity the professional requires to build his position. You have become a participant moving in the same direction as the dominant force in that market. When you identify distribution correctly through deteriorating upward momentum, through the effort to result divergence between volume and price advancement, through the labored character of rallies that once moved effortlessly, you are no longer buying into professional selling. You are stepping aside or positioning short alongside the informed operator who is already exiting. In today's algorithmic market environment, this alignment carries even greater significance. Institutional order flow in modern markets creates self-reinforcing momentum once a directional move begins. Trend-following algorithms, momentum systems, and quantitative strategies all amplify the initial move generated by professional accumulation or distribution. When you are correctly positioned before that amplification begins, the market's own mechanical structure works in your favor rather than against it. This is not a theoretical advantage. It is the most practical edge available to any discretionary trader operating in modern financial markets, and it requires no proprietary data, no institutional infrastructure, and no technological advantage whatsoever. It requires only the ability to read what price and volume reveal about the cycle, and the discipline to act on that reading rather than on emotion. The professional operator has always depended on your confusion to execute his plan. Your understanding of the cycle is the precise point where that dependency ends. The cycle was always there. The only question was whether you were ready to read it. You arrived at these markets the same way every retail trader does, armed with hope, carrying the genuine belief that disciplined effort and logical analysis would eventually produce consistent results. And somewhere between that initial confidence and the accumulated weight of losses that followed, something shifted. The market stopped feeling like an opportunity and began feeling like an adversary specifically designed to extract capital from anyone who dared to participate. That feeling is the most dangerous place a trader can inhabit, because it is simultaneously completely understandable and completely incorrect. Pause here, before the conclusion of everything presented across this entire body of work is drawn. Before the full weight of what has been revealed is genuinely absorbed and carried forward into your trading. Understand what you have actually been given. Across every keynote examined, from the existence of the cycle itself to the engineered nature of every significant price movement, to the structural logic of accumulation, uptrend, distribution, and downtrend, to the deliberate liquidity grabs that stop retail traders out at the worst possible moments, to the universal repeatability of professional behavior across every instrument and every time frame, one single truth has been present beneath all of it. The market has always operated according to a plan, a deliberate, structured, repeating plan, executed by professional operators whose methods have remained fundamentally unchanged across an entire century of market evolution. What has changed is the speed of execution, the sophistication of the instruments, and the technological infrastructure supporting modern institutional trading. What has never changed, what will never change, is the underlying human behavior that drives the cycle from one stage to the next. Greed builds accumulation. Confidence fuels uptrends. Euphoria enables distribution. Fear accelerates downtrends. And the cycle begins again, as it always has, as it always will. You now possess something that the vast majority of retail participants operating in today's markets will never acquire. Not because the knowledge is inaccessible, but because most will never invest the patience required to genuinely internalize it. They will continue reacting to price, continuing following momentum after it has already been established, continuing placing stops exactly where professional operators require them to be placed. You no longer need to be among them. The cycle is visible on every chart you will open from this moment forward. Accumulation reveals itself through exhausted bearish momentum and contracting volume on downward movements. Distribution exposes itself through deteriorating upward progress and the labored character of rallies that once moved effortlessly. The professional hand leaves its fingerprints on price and volume consistently, repeatedly, across Bitcoin, across equities, across currencies, across futures, because the underlying motivation producing those fingerprints never changes. Read the cycle. Identify the stage. Align with the dominant force. Protect your capital during uncertainty. Act with conviction when the evidence accumulates. This is not a complicated methodology dressed in simple language. This is the simplest truth the market has always been trying to tell you. The cycle was never hidden. You simply needed to know where to look. Now you do.